Welcome to the Stephan podcast, a podcast about Bitcoin and Austrian economics. Listen in as I interview the best and brightest entrepreneurs, business leaders, software developers, economists, writers, and analysts. This is episode 47, and my guest is Giacomo Zucco. Hardcore Bitcoiners already know who he is, but just for any listeners newer to Bitcoin, Giacomo is a well-known Bitcoin advocate, Supremo of BHB Network, providing Bitcoin and blockchain consulting. He's well known for his comedic speeches and has been around Bitcoin for a long time. So here's my chat with Giacomo. Giacomo, welcome to the show.
Thank you very much for inviting me.
Yeah, Giacomo, I've really liked a lot of your material that you put out and the talks that you do. So I just wanted to get you on. And actually, funnily enough, just last night I saw you posted this important thread where you mentioned that there is a critical or catastrophic vulnerability that will kill Bitcoin.
Yeah, it was actually a lot of fun. Basically, I think that it was triggered by the fact that somebody else was asking me in private messages to give my opinion about the thread, about the ununderstandable, unintelligible Andrew DeSantis tweet with Bryce Warner rebouncing it about this SegWit vulnerability. And so I was so annoyed that I just said I will tweet a couple of tweets about a new vulnerability, mocking these people, believing in everything. My expectation was not that somebody would really have been fooled by that, because in my opinion the irony of the tweet was immediately obvious since the beginning, because for example the first part, the first tweet at the very beginning of the thread starts with exclamative marks mixed with one numbers, which is typically when you're mocking somebody not very good with a keyboard. And then I suggested that I'm dumping all my Bitcoins in order to buy Ripple, Satoshi's Visions, Ethereum, and Dentacoin, specifying that Dentacoin is the most immune coin to this vulnerability. So then, of course, with point one, I started with the time travel communication mechanism, and then I moved to mocking the DeSantis DeSantis drawings on the screenshot. So, in my opinion, it was super obvious it was a joke. But actually, I'm still receiving now some nice death threats in my personal messages, and some people, especially tweeting in Chinese or Japanese using automatic translators, that are basically falling for that in Asia. So it's very fascinating, and also it was unexpected for me, but it's probably also very telling of the state of informational asymmetry, and also educational asymmetry and cognitive asymmetry, maybe that there is in this market, the general crypto market for sure, but sadly also the Bitcoin market. Some people didn't get the joke, which is really appalling.
Yeah, I think it could just be that to some, it looks like it's inside baseball, and really only people who are closely following it understand it. So obviously, people who are closely following the scene kind of know these jokes and know the references, but maybe, to an outsider, they could get confused.
Yeah, that's a good point. I mean, getting the joke in a sense of finding the joke funny requires probably a little bit of knowledge, not just about Bitcoin, but about also like the Bitcoin gossips and personalities and communities. So this is a very like insider joke. So getting in the sense of finding it funny, it's probably difficult for insiders. But getting in a sense that you should not base any kind of serious consideration on this kind of tweet, when you immediately talk about Dentacoin, and then you talk about time travel, and then you talk about not getting the joke, meaning treating this as something serious. I think it qualifies a level of absolute lack of understanding of not just Bitcoin, but probably internet and Twitter and irony and life and physics and basically everything, which is scary in my opinion.
Yeah, I thought it was a hilarious thread. Yeah, look, people should people should come out. I should title this episode "Giacomo Rage Quits Bitcoin."
Yeah, exactly.
And we'll get a lot of clicks on the downloads.
The Yeah, the Mike Hearn move. Yeah, Giacomo quits Bitcoin. Capitulation, beer market capitulation.
Look, anyway, we should bring it back to some more real topics that I had. So I've got a few topics prepared, Giacomo. One of them I thought would be good to get your thoughts. So there's been a bit of a trend. Now, there are positive and negatives here. So some people have been talking about this concept of releasing custodial Lightning wallets. Now, on one hand, people could say, look, that's encouraging the wrong behavior. The correct Bitcoiner ethos is that you should run a full node, hold your own keys. But then the flip side is, actually, it might not be a big deal. People are maybe not putting a lot of money in, and maybe it's more like a gateway drug. They start using the Lightning wallet with just a small amount, and then they go and learn more. What do you think?
So I think there is a couple of considerations that we can make about this. The first one is the consideration, the general rule rule of thumb about security circuses. So the point is that it's true that sometimes, often actually, security is in direct trade-off with user experience or intuitiveness of a system or time you spend to study it and to use it or cost. So sometimes you have to compromise, and low security systems can be a gateway drug for high security systems. So it's true that sometimes before you can get to an expert level and have a super complex cold multi-sig wallet with Glacier protocol and hardware wallets, you can just pass through a simple Bitcoin investment through a custodial, or before you go to a full Lightning Network node with complex submarine swaps things, you just use some centralized service like ChangeTip. But the problem is when you are not using, you are not aware of being using a low security alternative, and you think, or you are misguided, you are brought to think that you are using a high security, but somehow high simplicity alternative. Just to give you an example, when I tell you that you can keep your Bitcoin on an exchange, the trade-offs, especially after empty GOX, are pretty much clear. But when I start to sell you a fiduciary account like a Bitcoin wallet, so I try to confuse you with some kind of security circus, and I let you think that you are doing more security than you actually are. That's actually a net damage. So it's correct that you can move from custodial solutions to non-custodial solution, and custodial solution can be a good gateway drug for this kind of things. But custodial solution do not need Lightning Network at all. If you remember, there was for Bitcoin. I mean, Bitcoin was always bad for micro payments and instant payments by definition, because even when nobody was using it, so fees were very, very low and sometimes inexistent, and zero conf double spend were very rare and sometimes inexistent. Still, it was a lot of friction to use the on-chain part of Bitcoin, which is not really useful for instant and cheap transactions. So people, in order to micro tip other people, were using a centralized solution, custodial, called ChangeTip. It was a solution in which you charged your ChangeTip account, fiduciary account, with one Bitcoin on-chain transaction, and then you could just tip people off-chain using this custodial solution. So I don't think there is anything inherently bad about that. If the trade-off you are making, it's very, very clear. But Lightning Network is an evolution of that, meaning that we are now reaching to a trustless, permissionless, and non-custodial alternative of micro payments and microtransactions and fast transactions. And now the trade-off is clear. We are safer, not as safe as with on-chain Bitcoin transactions. So there still is a trade-off. When you're using Lightning Network, your keys are basically hot, so it's less secure. The security model is punishment based instead of validation based, so it's less secure. Also, you can have some kind of DDoS attack. So in a way, or you can lose your key. You can lose your device and it's not just like a BIP32 seed where you can just recover everything from the seed. In this case, in Lightning, you have more backup problems. So you are giving up a little bit of security to get a lot of good UX. But with custodial Lightning Network, this is very confusing. I mean, this is a security circus. What is the advantage from a custodial Lightning Network compared to a more simple, more clear, less confusing, and less, let's say, gaslighting custodial solution like ChangeTip? So it's this that I don't like. It's not that it's custodial, but it's just it's pointless, and it's pointless because it's used in order to make people think they are using something more than a simple ChangeTip like solution. Of course, there is one counter argument to this, which is the fact that if and when everybody is using the trustless solution, so everybody or a lot of people is using Lightning Network, then a Lightning Network custodial solution is better than a ChangeTip-like custodial solution, because on a ChangeTip-like custodial solution, you can only tip people on the same system. So it has very low social scalability. It has a lot of friction. It's not an open standard. It's a proprietary closed system. While if you use a centralized proxy to the centralized Lightning Network, you can have all the easiness, all the simple UX of a centralized trusted solution, but you can still interact with other people using Lightning Network. This would be the case of, you surely remember people in the late 90s, especially managers and entrepreneurs, asking their secretaries to print the emails for them. So they were just getting printed paper, so they were not using email in its full power, but the reason they were doing that because was to get connected with other people using the same open protocol of email. So it can make sense, but I will expect this. It doesn't make sense now. There was somebody pointing out that custodial Lightning Network wallet could be a rational thing if there was a lot of market and of e-commerce going on Lightning. So in that case, basically, a lot of people using Lightning. I want to use Lightning too. I'm not technical enough to run a Lightning node. Then I just use this kind of proxy. But why is people using custodial Lightning Network solutions right now? Not because of that, because you can still not really. Unless there are very few people that installed Bitcoin, Lightning Network custodian wallets in order to buy stickers from Blockstream or whatever, or to buy Pixel on Satoshi's place. But these are very, very, fringe scenarios. So for most of the cases, I think that the explanation is a security circus. So these people think they are using something technological, something exciting like Lightning Network, and they're actually just using a centralized account. So in this sense, it's a net negative.
Yeah, I think you made a lot of great points there. I particularly like the point you made where you were comparing it back to ChangeTip, and at least in the sense that it can, while you're interacting from a custodial hosted wallet, you can still interact with the open internet. And if more and more people start using internet commerce and, doing Lightning tipping, let's say, that may be another angle of adoption. And the other cool thing, well, I guess another observation that you might think about here is it might be easier technically to build a custodial Lightning wallet, and because there's so much excitement, that could be why a lot of people are trying the custodial angle compared to the, let's call it the more trustless or trust minimized model.
Sure. That's part of the general trade-off we were discussing. Centralized solutions are simpler to build, to bootstrap, and to maintain and to evolve. Unless the decentralized alternative becomes so widespread that basically you can just piggyback and leverage an open standard already maintained by thousands of other people. So to make a comparison, if you have a private network for an information technology network for your company in 1992, it doesn't make any sense to use the internet. because it's just more expensive, more complex to bootstrap. You just use a mainframe. Mainframes are perfect for a closed proprietary environment. So if you are in 1992, you just use a mainframe, and use the internet instead only for external interaction, to interact with other people with the open standard. But if you are in 2019, well, even if you want to create a closed system for your company, closed and proprietary, so you're not really leveraging the internet technology because you could just use a mainframe, you still use the internet, not because it's technologically efficient, but because it's socially efficient, because everybody else is already using it and you are still using it for any other use case. And so it's low cost to reuse it also for the closed environment, which I mean, I could do the same comparison with WhatsApp over the internet or walkie-talkie. If you have to send a vocal memo to a guy in your same building, you should use a walkie-talkie, technically speaking. It's more efficient. But use a vocal memo over Telegram or WhatsApp, which is crazily inefficient, technically speaking, because the voice will be encoded into packets, and they will go to your Wi-Fi, and then to your router in some IP random path, and then back to the 4G of the local telephone operator, back to the cell phone of your friend in the same building, which is crazy. The reason you do that is because everybody else is using that, and you are also using that for everything else. So it's basically social scalability, as Nick Szabo calls it. So this makes sense, but this also only makes sense when there actually is this kind of penetration of the market. It's a similar question of, using Bitcoin to pay for coffee. Right now, it doesn't make any sense economically, but also technically. It makes sense when you use Bitcoin for the things that you cannot do without Bitcoin. So to buy from the black market, to save your savings from inflation or confiscation, to do advanced micropayment things like machine to machine, because PayPal will not allow you, from a regulatory point of view, not from a technical point of view, to do micropayments. So you do that only because you cannot do that with fiat legacy alternative. But you don't do the normal fiat legacy payments with Bitcoin if you can avoid that, because it's more complex and also economically a little bit inconvenient. So we will pay for coffee in Bitcoin when everything else will be done in Bitcoin, and the momentum, the inertia, the gravity force of the open alternative will also attract all the closed legacy alternatives.
Yeah, I think the comments you make there are very much echoing this idea that it's really about what level of infrastructure there is set up to do a certain thing. So in that example where you're saying you text your friend or you voice message them using WhatsApp, well, the infrastructure is much better for you to do that than for you and your friend to both carry around walkie-talkies, that kind of thing. So it's ultimately, once we get to that point where enough people are using Bitcoin and Lightning payment, that it becomes kind of the easiest route for people to use. Another thing you've been commenting on recently is around altcoins. So as we enter 2019, do you still believe that altcoins, some of them are more like an honest but maybe misguided attempt, or are they scam coins that are distracting from the overall journey to global sound money? How do you think about some of these altcoins?
So I still think that a very limited number of altcoins are extremely interesting and also good faith experiments mostly, and maybe even useful for both the Bitcoin evolution and some specific use cases, at least arguably right now. A typical example is Monero. Monero is an interesting experiment of different trade-offs between scalability basically and privacy, because it's using the on-chain privacy idea, where you still have every node storing every information forever, but they store this information in an encrypted way with a ring signature and confidential transaction, and so the proofs are larger and heavier, so the validation is more difficult. So all the scalability problems of Bitcoin are made are made orders of magnitude worse in Monero, but you test this alternative in order to get more privacy. I would say arguably more privacy, because the point of privacy and anonymity and fungibility is also about anonymity set and liquidity. So if you use just a Bitcoin trustless tumbler like Join Market or Wasabi, Chaunian CoinJoin or TumblerBit or whatever, and there is more liquidity on this tumbler than there is liquidity on the Monero transaction right now in terms of value, then you're actually more private in Bitcoin than in Monero. So it really depends. If there are less users in Monero than users in the Bitcoin tumbler you're using, then there is a better privacy in Bitcoin. That's why things like Zcash don't make any kind of sense, because in Zcash there is an optional privacy, which is optional but more expensive. So you are supposed to pay more to have privacy, which is okay, but that means that nobody is using shielded transactions. So in Zcash, everybody is using normal transaction, and again, security circus, they think it's more private just because some marketing is telling them it's more private, just because they read it somewhere by some people, but it's not true. Actually, it's way less private because there is a very small anonymity set. Very, very few people are using Zcash, and very, very few people are using shielded transaction. So that even if you do use shielded transaction, you are not private at all, because the anonymity set is super small because nobody else is using it. So getting back to Monero, I can imagine that this experiment is interesting for studying the trade-off that can be helpful to evolve or build around or on top of Bitcoin. And also, I can imagine that for some specific use case, if you really have to mix your coins, maybe adding to your Bitcoin mixing also a Monero, a Monero transaction on BSQ, and then a Monero transaction, and then back to Bitcoin could also be something interesting. But there are at least two arguments for which I still think that even these honest experiments would better off if done without any new coin. The first one is a typical monetary argument. So the point that Bitcoin works because it's perceived by the market as scarce, as digital scarcity. Digital scarcity exists because you have a finite, predictable supply, so 21 million, etc., less than 21 million. But this is a scarcity of Bitcoin only. If you use other altcoins as substitute goods for Bitcoins, so if you can use digital scarcity with Bitcoin or Monero or Litecoin or Ether or whatever, and the market just treats these alternatives as basically the same thing, digital money, with very low frictions in exchange, then you don't have a predictable supply or capped supply anymore. You have a potentially infinite supply, because the cost for producing new Bitcoin is very, very high. You have to do proof of work at the proper difficulty, while the cost of producing an altcoin is basically zero. You take the code, open source code, you change a parameter, and then you launch. And the only real cost is marketing, but that's an unpredictable cost, and is not an inelastic cost. It's an elastic cost. The more your coin has value, the more you can invest in marketing, just like it happened with Ether. So it's a very bad form of money. So this first point will be that if altcoins are sustainably possible, then scarcity is sustainably impossible. So Bitcoin can fail because of altcoin, but altcoins cannot win and not coexist in a meaningful manner with Bitcoin. Of course, that doesn't mean that the price on the market of any altcoins will be absolutely zero. Zero is, nothing that had a price at a certain point in history will be for sure forever zero, because it can still be sold as a collectible. Maybe in 2030, some people will exchange a Litecoin private key for a price because it's a historical collectible. So nothing really goes to zero, but it will be probably irrelevant. So the first thing is that if you want to launch a legit experiment like Monero, but not just Monero, consider also maybe Namecoin for namespace decentralized assignment, or consider Saya coin for distributed, replicated, and distributed storage, or maybe the new very cool Mimblewimble protocols like Green. These projects are interesting and motivated also by legit use cases sometimes, maybe, and legit technical scientific inquiries for sure, and legit goals by the people promoting them, most of the people promoting them. But they would be better off if they could be either a Bitcoin sidechain, which means a new architecture with totally different rules and features, technically speaking, but reusing the same value content, which is Bitcoin. If you think about that, if you want to evolve from VHS to DVD to Blu-ray, you do evolve the medium, the infrastructure, but that doesn't mean that you have to throw away all the movies that you I mean, Hitchcock movies were on some kind of support, and now you can still enjoy them on the new support. You don't have to rebootstrap Hollywood history and cinematic standards every time you change the kind of support. If you go from gas engine to Tesla electric engine, you don't rebuild all the roads and the road system and the road signs just in order to use the new technology. So the point of sidechains would be to launch the new alternative experiment like Monero, Mimblewimble, but without trying to rebootstrap the asset again, which is also creates a second class of problems. Even assuming, and I don't assume that, I think that's false, even assuming that digital scarcity can exist with an unpredictable number of altcoins recognized by the market as money, still you have a problem of liquidity that I was talking about before. So let's consider, for example, the very naive view that you can save money using Litecoin as a transactional coin, while at the same time storing your value long-term in Bitcoin. So you have Bitcoin as a store of value, and then your counterparty, the merchant, likely has Bitcoin as a store of value, but you use Litecoin as just a transactional money. This doesn't make any sense, because in order to do that, you have to move your Bitcoin out of your cold storage to a market. So you pay an on-chain transaction with or whatever with Bitcoin. Anyway, you move Bitcoin. Then you pay a market fee to change Litecoin. Then you send the Litecoin to your merchant. Then the merchant will likely have to move to change on a market again and to move back to his cold storage. So yeah, you can get some efficiency by batching. So you can do a few Bitcoin transactions from and to exchanges and then back to storage. But still, the point is that this doesn't make any sense. You are paying more. You are paying more fees. It only makes sense if you assume that either you and the merchant are actually using Litecoin as a long-term store of value. But if you are assuming that, then you are assuming not a new form of transactional. You are not really differentiating the functions between store of value and transactional money. The same thing applies actually with Monero. So assume you are keeping your value in your Bitcoin cold wallet, and the merchant will eventually have to do the same. So the value proposition of long-term censorship-resistant store of value is served by Bitcoin. Then now you want to be private, and you have to move Bitcoin to a market, to sell those Bitcoin for Monero, to send Monero for the merchant that will have to sell to move back to the market, exchange for Bitcoin, and get the Bitcoin back to the cold storage. Of course, the assumption that the cryptographic privacy of Monero compensate for the lack of privacy of any kind of market. I mean, if you go on a market, you will have to mask to go on probably masking your IP with Tor, but you will leave traces, you will leave privacy leaks everywhere. You are basically compensating everything you're getting from the altcoin by the fact that money has to be usually both a store of value and a transactional instrument at the same time. So for this reason, I'm skeptical about this project, even when the underlying technology is interesting. So for example, Zcash is not technologically interesting for me, or Ethereum is not at all technologically interesting for me, but Monero is. But that doesn't mean that the sidechain will be better. Even if you can't do a trustless sidechain, which is still very, very speculative concept, maybe you can do a trusted, semi-trusted sidechain like Liquid or like Rootstock, or maybe you can just do, I mean, if you really cannot do any of that, I think the best thing would be to do a proof of burn. So basically, the new coin is generated every time you destroy Bitcoin, which is like a one-way side chain, which would be better than creating a new coin from scratch. Not really a side chain, but at least you don't inflate Bitcoin, and you can get the new coin trustlessly without passing through a market, at least in one direction, if not in the other. And if you cannot do that, maybe the fork, improperly called fork, basically the UTXO airdrop strategy, it's better than the pure from scratch altcoin. Of course, it has been used in order to scam people, for example, by Bcash and now BSV and BAB. So it was dishonest. It was scammy because people like Roger Ver and other used the fact that there was a UTXO airdrop in order to promote their altcoin as Bitcoin. But if you don't do that, if you create a new coin like a new green, a new Mimblewimble coin, and instead of creating a new monetary value from scratch, you just give that monetary value to people based on their Bitcoin UTXO, that's that would be for me the third best. The first best, a sidechain. The second best, a proof of burn, like one-way sidechain. And the third best, a UTXO airdrop. So at least you don't force to people to move through a market in order to acquire the new thing, so they can move trustlessly from store of value in Bitcoin to the new features of the new coin, and at least you are not inflating Bitcoin supply and digital gold overall supply. So that's the reason I'm still skeptical about this experiment, even when they are interesting.
Fantastic comments, Giacomo. I think the other thing, and you were touching on this, is just this self-reinforcing nature of liquidity. And it may very well be that some altcoins out there may be marginally better on one or two certain attributes. So let's say Grin might, even if we can see that it is better from a privacy point of view, it may not be better on an overall point of view. And ultimately, if something's going to win in the market for money, it sort of has to win overall, would you say?
Yeah, that's exactly the point. Privacy is just a sum of local privacy of that transaction plus global privacy of your anonymity set. And saving in fees is just a sum of the saving you do from a technical point of view of that transaction plus the saving you do in order to not change on the market between one and the other coin. So yeah, what I will really agree with your definition. Money usually has a strong interconnected. Needs strongly interconnected functions in every field. You cannot have just one money which is better for this and one which is better for that. I agree.
Fantastic. And I think the next idea I was keen to discuss with you is just around this discussion that's been taking place over the last year or two around Bitcoin's financialization. So some people have come out and said, well, is it that Bitcoin needs an ETF and the financialization, or does finance need Bitcoin?
Very good question. I will argue for the second. I think Bitcoin doesn't need financialization because financialization usually provides all the things that are already provided for traditional market asset class. So all the things that you think you can get from financialization, like regulation, legitimacy, security that your government will not try to get it, or anything else like or free marketing, like because legitimacy is also used as marketing, or social acceptance. These things are already there for US dollar. So why do you need Bitcoin if you already have these things in the US dollars. Maybe you need Bitcoin because you want censorship resistance and impossible to inflate money. But if that's the case, the reason you cannot have it with the dollars is exactly because the dollar is financialized and regulated and easy to regulate and to censor, and basically completely controlled by government-like institutions like central banks and financial surveillance mechanism. So if you want to pay when people doesn't want you to pay, when people don't want you to pay, you need Bitcoin, not because it's financialized, but because it is not financialized and regulated. So there is a strong trade-off. But if you one could argue that not only Bitcoin doesn't need financialization and regulation, but it's the other way around. Any kind of financialization could bring value, could just drain value out of Bitcoin, just like a financialization of gold made basically possible the great censorship and the great expropriation of gold from the market. So when gold was an effective alternative to fiat money, inflation, basically and also to financial global surveillance, what governments did was to ban gold. Basically, Roosevelt in US and Hitler in Europe, and every government which tried to establish a close control over the population had to ban the monetary use of gold. I mean, using gold as monetary mean was a criminal offense in the US under Roosevelt, and or even gold representative like IOUs. That's the reason that's the only way you can implement a fiat monopoly in your market. So one could argue that you have, that was possible. Banning gold was possible because gold was heavily financialized. So there was not many people using gold in their private face-to-face transactions, and many people using gold IOUs. And so it was easy to inflate the paper gold supply and to ban gold and so on. And some could argue that if Bitcoin gets heavily financialized, it becomes easier to censor because you cannot censor the base layer, but you just censor the second trusted regulated layer, which is actually true. I mean, if nobody uses Bitcoin directly and everybody uses Bitcoin through a centralized payment processor, then censoring Bitcoin is super easy, and then there is not any point for Bitcoin in the first place anymore. So Bitcoin doesn't need financialization, but it could financialization if not balanced by an exit option, an easy exit option, could even be dangerous for Bitcoin. On the other way, I think that the financial world needs Bitcoin because for the simple reason that it's a heavily uncorrelated asset. So when you build a financial portfolio, you want decorrelation. You want things that are decorrelated, uncorrelated, or to your traditional asset classes. And Bitcoin is such a thing. Not altcoins, actually. Most altcoins are strictly correlated with Bitcoin, with some noise, which is basically correlated with marketing efforts of the centralized altcoin team. But if you take off the marketing noise, like the new partnership of Ripple or IOTA or DentaCoin, if you take this marketing out, you have basically a strong correlation between the altcoin and Bitcoin. Well, so it's basically just like a Bitcoin derivative. So they are useless to create a diversification. You do not diversificate your portfolio with altcoins. But if you have a traditional portfolio of cash, equity, and obligations, then you can and commodities, then you can diversify it with Bitcoin because it shows a strong non-correlation. So it doesn't mean that Bitcoin has to go up to provide this value. Bitcoin can go up or can go down. The point is that it doesn't have to go up and down together with the asset classes you already have in your portfolio. And decorrelation is a powerful, non-correlation is a powerful tool for your portfolio strategy. It can be used and also controlled and balanced and put in check with many strategies in order to have a better portfolio performance overall. So I think that governments will right now control and regulate the regulated white financial market. They don't need Bitcoin, and they should be afraid of Bitcoin. But the market actors that are operating in this white market, like the investors, basically, they have any reason, and they should have any reason when they start to understand it, to be interested in getting Bitcoin. But of course, if you are a Swiss or American investor and you just want to if you just want to speculate on the non-correlation of Bitcoin price, you don't need to build to learn to run a full node to store your seed. You don't want that, because you're already a regulated investor. You just want to call your bank and to ask to your bank to buy these shares, these bonds, and these Bitcoin. So there is a market for financialized Bitcoin, which is not the same market for Bitcoin first level users. It's a mass market for Bitcoin second level users, or Bitcoin pure investors. So people who doesn't care about using the censorship resistance property. They just care about the fact that other people care that this is a useful function.
Fantastic. I've heard some people describe that as people who want Bitcoin flavored risk. Now, on that topic, you mentioned how there would be a market for financialized Bitcoin. Now, then the question comes, how much of the overall supply could these financialized Bitcoin services hold versus some of the OG hodlers and newer, hardcore Bitcoin holders?
That's a very good question. Arguably, this is also a question that somehow addressed the point about security risk for Bitcoin if too much value moves to a censorship-prone layer, like the financial regulator layer. The bet is that it will be not too much. I mean, right now I cannot measure or predict how much is too much, but I will say that a strict minority of the market should be on those markets, or on those regulated markets. Otherwise, I mean, Bitcoin is not completely doomed, but there are serious security risks, because if the regulator can just can censor the great part of the liquidity or of the market suddenly, that's a huge security and usability problem for Bitcoin. So it would be, of course, it will be great that this financialization, which I think is inevitable and ultimately also good, because it increases the value of the collateral Bitcoin, even if there is fractional reserve or anything else, it still increases the value of the collateral. So it's inflation in a way, but it's inflation which brings new demand to the supply, basically. So that's a risk. I don't know. Frankly, I don't know how to measure, even how to imagine a measure of that. What I can say is that usually that's not a fatal risk. Is not a ultimate risk if you still have an easy exit option. I make you the example of gold. So gold is heavily financialized. That means that the price of gold can be manipulated once or twice or three times by some strong regulatory intervention, by some central bank of the Federal Reserve or the China central bank. They can manipulate the price of gold because it's heavily financialized, but up to a certain point. They cannot completely manipulate forever the price of gold, because the market can skip. I mean, when you exaggerate with the fractional reserve, you can actually withdraw gold. When you really need to store gold for some reason outside the regulated market, you can, because it's physically possible. While with fiat, it's actually impossible to escape the regulatory trap, because fiat doesn't exist outside the regulatory, economically and even digitally speaking. Fiat doesn't exist outside. I mean, except for a very low amount of of US dollar cash, paper cash, which still it's used in the black market, but it's super easy to manipulate by the Federal Reserve because the supply is just trivial to change. While gold, is still more resistant to manipulation. A heavily financialized gold is more easy to manipulate than non-financialized gold, but still somehow difficult to manipulate over a certain point. So there is like a security feedback, a security measure, ultimate security measure. Bitcoin arguably is even better than gold because getting your gold out of a caveau is super expensive and slow and difficult, while getting your Bitcoin out of a custodian solution is arguably easier. And if the custodian solution doesn't want to give you back the Bitcoin, you know why and you get it immediately. While with gold, there is more plausible deniability because it's difficult to move, etc. Also, Bitcoin is easier to hide than gold, easier to transfer across continents. So it's arguably even better than gold from that point of view. So it is a security vulnerability. The fact that the financial sector could own a huge amount of Bitcoin liquidity or market cap in a regulated part. But the thing is that basically, if something bad happens to that kind of regulated Bitcoin, by definition, the only interest in Bitcoin becomes the unregulated Bitcoin. So the whitelisted Bitcoin basically becomes worthless because it's not anymore resistant to inflation because you can inflate with fractional reserve. It's not resistant to censorship and expropriation and confiscation because you can confiscate it because it's regulated and custodial. So there is no value proposition on the whitelisted Bitcoin anymore. The whitelisted Bitcoin, the Bitcoin flavored risk, has value only insofar the market thinks that it's strictly convertible and easily convertible and redeemable into a real Bitcoin with strong censorship resistant properties. If that's not the case, for a while, the market will price it. And so the whitelisted Bitcoin would basically go towards zero. And the real Bitcoin will become only the black market Bitcoin.
Right. And I suppose your ability to withdraw that Bitcoin out into your own full node obviously kind of gives you a possibility of saying, no, look, this is Bitcoin proper and not, financialized Bitcoin. And I suppose we would anticipate in some sort of fractional reserve system that a difference in the price would emerge, and Bitcoin, full reserve Bitcoin, would trade at a different price to the suspect fractionally reserved Bitcoin.
Yeah, absolutely. Yeah, that's why it's important to understand that. Not your keys, not your Bitcoin. If you're not the only person or party holding the keys for your Bitcoin UTXOs, those are not really your Bitcoin. They can be taken from you. You don't have any guarantee of the censorship resistant properties. And also, if you don't run your own validating full node, not your new Bitcoins, meaning that when you receive Bitcoin and you don't have a full node to validate that you receive Bitcoin, if you use a mobile wallet with Bloom filters, you are not really validating your Bitcoin. You can be fooled, you can be tricked, you can be scammed, you can be hijacked by any kind of external attack or special interest.
Right. And speaking of attacks, I think that's probably another coming topic of Bitcoin has obviously faced many attacks over its now 10-year history. There may be bigger attacks to come, and we can talk about how likely are they to succeed. One example might be a nation state trying to hijack the network with a mining attack. Perhaps they could rent some hash power, maybe, or like maybe some rich person or rich group of people could try to, say, put in a short position on Bitcoin and then try to attack the network. Do you think such a thing is likely to happen or possible?
I don't know if it's likely. I think it's definitely possible. There is a very good modelization, economical and game theoretical modelization of this scenario by Eric Voskuil. You can find it on the LibBitcoin crypto economics repository on GitHub, Eric created this very nice model. He thinks that this scenario is not just possible but basically necessary. I don't think it's necessary, but I think it's definitely possible. A scenario in which the government if so he doesn't think it's necessary. If Bitcoin is going to succeed in being resistant to regulation, then the only thing that government can do if Bitcoin is succeeding and spreading and resisting regulation is to try to censor it mining. So acquiring, renting, or whatever, printing money or extorting money through taxation, and using this money that it printed or extorted in order to buy or build or rent ASICs and mine Bitcoin. When you mine Bitcoin, if you reach the majority and if you can keep the majority of the hash power, you cannot change the rules of Bitcoin, so you cannot change the validation rules, but you can censor transactions, because you can just say this kind of transaction, for example, the transactions that are not whitelisted in this list are not going to be confirmed on the network. So the interesting thing is that now there is the Eric Voskuil scenario depicts now a race between the government mining and the black market mining, meaning that the government has a subsidy for continue spending in hash rate by taxation, while the black market has a subsidy to try to overcome the 50% of hash rate by the black market transaction. So the idea is, let's assume there is a demand globally for censorship-resistant transaction, for transaction of a certain kind. Let's say that the government wants to censor these transactions, so they pay in order to acquire hashing power to censor these transactions, but there is still demand. So when the demand gets high enough, the black market will simply pay more fees, and the fee mechanism in Bitcoin is already basically it's ready for that. Basically, if you are if you are a Venezuela guy that wants to move Bitcoin to another guy without the government sending you to jail, if you are whatever, a China guy that wants to export capital or to sell against commercial blockades and embargoes and stuff like that, then you will put a very high fee. And so if the government doesn't take that fee into a block because they are actively censoring, some miner will eventually overpower the government, because there is money to be made into competing with the government. So this is interesting security scenario of a race between governments and black markets. Is not a scenario with a clear long-term winner. It could go on for a lot of time, and I'm not sure that's a realistic case, because when you talk about game theory, and especially public choice and politics, there are a lot of recursive arguments, like if the governments understand that that's the case, they may not even try to do that, because that would be pointless in the long run, etc., etc. So yeah, it's a very fascinating hypothesis. There is a let's say trivial variant of this hypothesis, which is the government not spending money to acquire hashing power but to destroy hashing power, which is also interesting, because if the amount of hashing power destroyed is high enough, then Bitcoin will just adapt difficulty with the difficulty adjustment. But as we know, the difficulty adjustment for very good reasons is not super fast or super or all powerful. You can only adjust some percentage of difficulty, I think like 20% or something like that, and you can just do that every 2000 something block, 2016 block or something. And if the hashing, so let's assume that tomorrow the China government managed to acquire and destroy all the ASICs in China, and let's assume that you drop the Bitcoin hash rate by 60%. So you don't stop Bitcoin, but you can really make the Bitcoin user experience worse for a very long time. Of course, there are two objections to this scenario. The first objection is that it's a unrealistic scenario because you have to make sure that you have a group of government employees that will go to seize ASICs, and they will really destroy the ASICs instead of just lying to their supervisor and employing the ASICs in secret in their own facility. So corruption in public choice is a very powerful force. So you have to have a government without corruption, which is basically impossible. And the second argument is that eventually, I mean, I'm not sure that's something doable very, very often, but the Bitcoin market could fork away from this kind of scenario with some kind of proof of work adjustment. I think that would be very traumatic and it could create a lot of coordination problems. So it will like be the super last resort, like the atomic option for Bitcoin. But in extreme scenarios, there is also this atomic option, which means that the government is less likely to try to go in this extreme scenario, because if there is an atomic option, you don't always have to use the atomic option. Its existence itself can be enough to be a deterrent.
Fantastic explanation. I think it's just that, yeah, so ultimately the very existence of it as a threat or the possibility may kind of stop a person from trying that attempt to attack Bitcoin. Now, another way a government could attempt to, let's say, outlaw Bitcoin, and there are different pathways we could think about. So one angle is, hey, that would create competition, and other governments or other states around the world might want to make it legal to attract Bitcoiners. But then the flip side of that is, okay, maybe the governments can successfully collude and do things similar to immoral organizations like the OECD, who try to coordinate government efforts on taxation and try to raise taxes everywhere.
Yeah, I think that the tax example is very, very good in showing that government competition can be an exploitable arbitrage windows for a while, for sure, but it's usually not very an equilibrium. Is not a stable equilibrium long term, because what defines a government, at least in the way we usually use the word, is the taxation process, and in the modern world is also the currency inflation process, and the legal tender laws and the monopoly over money. So these are like constituent elements of what we define as a government today. So being this the case, you can have a opportunistic government that right now doesn't participate to the ban of Bitcoin, or even it's very friendly to Bitcoin. In the interesting modelization of Eric Bosquill, he says that in this case, this specific government is not part of the government as an economical abstraction, but is part of the black market in a way. So you can have competition among governments, but usually you have collusion in the long term, because the interests of all these agents are ultimately aligned in favor of taxation and inflation. If you think about tax havens, it was a thing. I mean, the 80s, in the 90s, you could effectively avoid taxation and inflation in some cases, just arbitraging across different nation states. You know, all the theory of the sovereign individual. You just do geographic arbitrage between nations. But right now with FACTA, one after the other, every single government in the earth started to report tax information to FACTA, and I mean.
Sorry, we'll just explain that just for listeners who don't know what that is. That's FATCA, Foreign Account Tax Compliance Act, and essentially, basically, the U.S. government requires other governments and other banks to declare which of their customers are US citizens, and then they try and use that to basically identify taxation and revenue. And other countries are using a similar thing called CRS. Sorry, go on.
Yeah, exactly. And of course, also the other countries are leveraging the same system. So, for example, Italy, since there is a new automatic exchange of information based on FACTA, Italy will leverage that in order to have information to all the Italian residents doing business abroad with other banks. So there are some places that still didn't sign this kind of agreements, like Dubai, but they're like every year they are less and less and more cornered. Like Switzerland was a very clear example of resistance toward this to this global Orwellian surveillance. But basically, they suffered a commercial, I would call it a commercial embargo threat from the US until they surrendered their bank secrecy. And the same topic also applies to sound money, to hard money, to resistance to inflation. Basically, there were some kind of competition among central banks, but that basically tended to converge over a US-centric and Federal Reserve-centric global system. Right now, you see some kind of differentiation from that, because you have maybe China and other, maybe Russia, trying to get away a little bit from the basic monopoly of the US dollar, of the reserve global reserve as a global reserve currency. But it's still, I mean, the global trend, the long-term trend is over collusion of states in this regard. So I think that this idea of regulatory arbitrage like Bitcoin will be banned here, but maybe it will be still, allowed, but even encouraged there. Could work well short-term, but not long-term. It's just like, the same thing, a little bit less scammy, but it's the same thing for the ICOs. Basically, if I do an IPO, if I just sell the shares of my company to the public investors, I will have to spend a lot of money for compliance and regulation and paperwork and certifying the accredited investors and so on. And then I will have to avoid that these shares are bearer instruments on the secondary market, because otherwise the government cannot control the money. So they will want everything to be nominal and not bearer instruments. So I have a lot of regulatory cost. If I do an ICO and I tell all the people that I'm giving them voting rights and dividends, just like a share, but it's not legally a share because it's different. So I'm trying to trick the regulator into thinking that I'm doing something which is not a share, but I'm trying to trick the investors into thinking that I'm doing something which is actually is a share. This can maybe work for a while, but eventually just for, as we have seen with the ICOs, eventually the regulators will understand that these are used as share by the market, so they will try to regulate them as shares. And the investors, they will understand that the company is actually legally defining these things not as share but just as collectibles, without any relation with the revenues of the company or the profits. And so they will understand that they have been, both the regulators and the investors will understand that they have been scammed by the ICO runner. So it's not a long-term solution.
Right. And the other thing I wanted to bring up that I'd like to get your comments on. So right now, we are seeing a little bit of this whole regulatory whack-a-mole game with exchanges who have trouble getting a bank account. And often, even, despite Interpol coming out with a report saying Bitcoin is not really used that much in money laundering, it still seems to be the case that many banks are, obviously, they live in fear of losing their banking license. And because of AML laws and so on, they still are kind of scared to bank Bitcoin companies and Bitcoin exchanges. But to that same point that you were making earlier, that the more the world is sort of clamping down and a lot of the old tax havens of the past or bank secrecy laws and so on that used to exist in Switzerland have kind of been eroded and clamped down, the more the government keeps closing and clamping on things like AML, KYC, the more it starts to eventually push people all the way over to the other side. And what we're starting to see now is things like this whole Patreon MasterCard drama of Patreon shutting people down because they're worried about their banking relationship with MasterCard. At the same time, that drives more people into the arms of Bitcoin overall.
Yeah, I think that this raises some points, I would say a little bit philosophical points about government intervention in the economy. So basically, the government as a concept, as an economical exception, has any interest in controlling the economy, but it is very bad at controlling the economy because since it is the government, so it's violently monopolistic. it becomes very inefficient and very corrupted for public choice reasons, and so it doesn't work. So one thing that government usually does is to outsource some basic functions to some almost market entity that is more efficient because it's coming from the market, but is basically included legally into some kind of regulatory privilege and regulatory monopoly. The typical school book example of this is the Eastern India's company when the American patriots rised against the British crown, they didn't really attack first the British government. They did attack the East India Company, a private but monopolistic company. So this is the same for a monetary function. The governments tried to manage inflation directly with the national, the direct printing, but they were very bad at that. So they tend to delegate this kind of printing to this almost external, still political, but almost not government dependent. Not strictly politically dependent central bank. So it's more like a technical entity outside the government, and especially commercial banks that are part of the cartel, a legal cartel. So they are part of the violent monopoly, but they are almost competing. So there is some kind of pseudo competition, and that keeps them a little bit more efficient and more anti-fragile. So basically with monetary with fractional reserve, the commercial banks are helping the government to inflate the currency, and the same goes for traceability and censorship and surveillance enforcement, which is basically performed not just by the government directly, but also through these third-party outsourcers that are commercial bank cartels. So the interesting thing is that the government understood very, very, very quickly, historically, that it doesn't have to inflate the base currency too much, because commercial banks can just inflate it more. Or if they want to create a bubble, like with the subprime mortgages, they don't have to create the bubble necessarily directly from the government. They can just they can just pass some legislation that will make commercial banks behave in a certain way in relation with interest rates or mortgage evaluation or stuff like that. So they can just drive commercial banks to do their job instead of them for some very compelling reasons. The same applies to KYC regulation, but also to other things. Like you have prostitution. Government did historically try to ban prostitution, but it was such a eradicated phenomenon that it was impossible to go around and just arrest people. So they just tried to shut down the centralized counterparties, market counterparties that can be used by prostitution in order to promote the service or to pay the service, like Craigslist or Backpage or anything like that. Same goes for marijuana or other recreative substances. You can ban it, but it has a very strong popular demand and popular support, so you cannot ban it forever without getting unpopular. So you just basically you ask the banks to not open bank accounts to legal marijuana companies, so that you are effectively banning something without banning it formally, which is the same for Bitcoin. The governments do not have to outlaw Bitcoin for now, because they can count on the fact that the banks will continuously avoid to, because they're scared, not because of business reasons. Because from a business perspective, you want more clients, you want to serve a market, but they are scared of the regulators. So since they are scared of a future regulatory retaliation, most of these banks are basically not allowing crypto business, which is odd, because now what this is causing is that it is driving two things, as you said. The first thing is that it's driving even more people away from banks, because they will just stay in the gray market and the black market directly without even passing by the white market. And the second thing is that Bitcoin and shitcoin exchanges are trying to become banks themselves. So since they cannot use banks to open their accounts, they are trying to enter the regulatory cartel with the government directly, with some kind of selling points, like we will help you to regulate, we will help you to survey, we will help you to trace and to crack down and stuff like that.
Yeah, that's an excellent point. I think you're really hitting the nail on the head there, that governments often deputize private companies and use regulation as their means of doing that. And what we're seeing now is some of these large Bitcoin exchanges trying to go that same angle. But I think ultimately then, in some ways, there's some bullish arguments there as well at the same time, as you said, that it may just drive people to just stay entirely within Bitcoin, just earn Bitcoin and spend Bitcoin and just, totally stay within that economy. So that may be an interesting thing we see play out. But look, Giacomo, I know I've kept you for a little bit over an hour now. So how about you just give the listeners an update on what you're up to, maybe just some closing thoughts and anything they can look out for coming up from you, and also obviously tell them how to find you online.
So they can find me online mostly on Twitter. I'm mostly active there. So Giacomo Zucco, my name, without space, on Twitter. What I'm up to is mostly trolling other people, like you have seen with the Bitcoin emergency thread. But I also try to do some work. So basically, I do consulting for a living. So I consult company about Bitcoin since some years. That's my first for-profit occupation, consulting and teaching. Actually, I'm trying to move more and more from consulting to teaching, because consulting is getting really boring, and teaching is more interesting. So of course, I'm not a developer. I'm a theoretical physicist as education, so I cannot teach like Jimmy Song style or stuff like that, the code directly. But I think I have some education skills that I can use for profit. And for non-profit, I mostly use the proceedings, the profits of the consultancy part, in order to boost and help and fund and sponsor open source non-profit activities. Right now, for example, I would love to sponsor people working on Wasabi Wallet, or people working on the BTC Pay server, or a joint market initiative, or RGB, Open 10 Stamps, Proof Marshall. There are a lot of interesting projects that I try and I would like to help. Until the last September, I did that with my BHB Network initiative, which is basically me and my wife and other friends. And in September, we decided with Alena Vranova, now of Casa Hodl, to build together a new instrument to do that, called the Bee, which also created a lot of controversy, because it's actually a foundation. So somebody is scared by the tragic fate of the Bitcoin Foundation, but it's something different. And we are super late with that, mostly for, no surprise, regulatory reasons. So we want to be sure that we can accept donation from businesses, from incorporated businesses, that of course will have to be able to write off the donation as an actual donation to a legal entity. But at the same time, we want to be able to donate these Bitcoins to anonymous or pseudo-anonymous developers in exchange for proof of PR on GitHub, basically. So that's tricky. We were probably underestimating the regulatory part of that, so we are late. But I think we are coming. So I hope to give some news in very soon about the Bee and what the Bee wants to do.
Fantastic. Well, look, Giacomo, I think this has been an excellent conversation. I've really enjoyed speaking with you, and thanks very much again for coming on.
Thank you for inviting me. It was fun.
I think Giacomo offered some great insights in this episode. Let me know what you thought of the episode, and you can find me on Twitter. My handle is @StephanLivera. If you like this material, please help me out by sharing it, liking it, thumbs up on YouTube, give it a rating, review. Also, go to my website, www.stephanlivera.com to find out more. If you want to get rid of your fiat money, come and donate it to me at patreon.com/StephanLivera. If you want to donate using Bitcoin or Lightning, use Tallycoin, which is at tallyco.in/StephanLivera. Thanks guys, chat next time.